Good morning. It's Wednesday, the 12th of March, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming as always from Mumbai, a very warm financial capital right now. And just before we start, this is a holiday-shortened week. We have Holi coming up in a few days, so there will be no edition later this week. Our top stories and themes for the day. Can the Sensex hit 105,000 by December 25? Going back to the 101 of investing and stock picking in these times. Oil prices are still steady, holding around $70 a barrel. Elon Musk partners Airtel to bring internet services into India via satellite, even as Tesla car sales crash globally. And what does Reliance Retail's downsizing mean for the retail industry?
This is a call report with Govindraj Ethiraj.
Morgan Stanley puts it out there. This is, of course, a hedged call with the downside offered alongside the upside, but it's worth noting that Morgan Stanley has been brave or foolhardy enough to call a Sensex at 105,000 in December 2025. Now that makes it nearly 41% up from the current levels. Even Morgan Stanley's base case is optimistic from the current levels at 93,000 by 25, that's December 25, up around 25% from the current levels. There is, of course, a bear case scenario where the Sensex goes down another 6% to about 70,000 levels by December 25 again. Now, it's quite clear that people are projecting beyond 2 quarters or so, as we will shortly hear. Before I come back to Morgan Stanley and its calls, on Tuesday, the market started weak as they were expected to on the back of the pounding seen on Wall Street on Monday, thanks to the Trump uncertainty and the prospect of damage, if not an all-out recession in the US economy, something that President Trump himself did not rule out. But unlike earlier trading sessions, the bulls were pulling back almost every point that was being lost, almost like a continuous tug of war, where you could see the fight was slightly stronger on the bull side, though the markets did close down slightly, though only the Sensex. The Sensex started the day with a negative gap of about 371 points, inched up and finally closed down just 13 points at 74,102. The Nifty 50 wandered around but closed with a gain of 38 points at 22,498. There was an interesting stock movement with IndusInd Bank, its stock falling about 27% after it said that an internal review of its derivative portfolio showed up discrepancies for which it estimated losses of about 1,577 crores or about 2.35% of its net worth. But the broader markets were steady with the BSE MidCap going up about 0.7 and the small cap going down the same level. On Wall Street on Monday, it was party time for the bears. All the indices took a beating with the Nasdaq Composite seeing its worst day since September 2022. The 30-stock Dow Jones, which lost about 900 points, closed below its 200-day moving average for the first time since November 1st, 2023. Nasdaq, as we said, saw its worst day since September 22. When asked about the possibility of a recession, President Donald Trump said in a Fox News interview over the weekend that the economy was going through a period of transition. Earlier, Treasury Secretary also told CNBC that there could be a detox period for the economy as the administration slashed federal spending. Meanwhile, Wall Street looked like it was set to face more selling pressure on Tuesday after stock futures were showing flat overnight and investors struggled to gain ground after that steep sell-off. CNBC reported S&P futures and Dow Jones and Nasdaq 100 futures were all trading lower. Now, back to Morgan Stanley's India outlook, which is definitely more bullish. It said that valuations now are most attractive or the most attractive since COVID-19. That gives you a clean 5-year horizon. This is likely to be a stock picker's market in contrast to one driven by top-down or macro factors since the COVID pandemic. And that's, of course, an interesting way of looking at it. For the markets to stage a recovery from here on, most crucial cue, according to Morgan Stanley, will be global factors, including US policy and global growth rates. Well, they also said that a global recession or a near recession will challenge their call and keep Indian equities off the highs in 2025, though their picks are cyclicals, defensive, small caps, mid caps, and large caps. More specifically, they are overweight on financials, consumer, discretionary, industrials, and technology. And the top stocks that they are overweight, so if you want to keep a watch in whichever way, is Jubilant, Mahindra & Mahindra, Maruti Suzuki, Trent, Bajaj Finance, ICICI Bank, Titan Company, Larsen & Toubro, Ultratech, and Infosys. The larger pitch is that India will be the world's most sought-after consumer market, will undergo a major energy transition as energy consumption increases per capita. Credit to gross domestic product will rise and manufacturing could gain share in GDP. All of these are, of course, somewhat general trends which are all likely to materialize. The time frame, of course, could vary for some of those cases. However, Morgan Stanley does talk about a consumption recovery which is expected to get broad-based as the income tax cuts propel urban demand to support the buoyant trend in rural consumption levels as well. So now, whether those income tax specifically trigger consumption jumps is something that we have to see, and that's a question I'll be posing shortly again as well. Now, that's in India. It is a fact that global flows could shift around in coming days given the massive selling that we've seen in the US markets. Interestingly, Citigroup has downgraded US equities to neutral from overweight while upgrading China to overweight, saying that the US exceptionalism is at least on pause. Citigroup has been overweight American stocks since October 23, and now things are obviously changing. And they also said that Chinese stocks look attractive even after their recent rally, given DeepSeek's AI technology breakthrough, the government support for the tech sector, and still cheap valuations. All points to note. Back home again, I spoke with Sumit Jain, Deputy Chief Investment Officer of ASK Investment Managers, which calls itself India's largest discretionary equity portfolio management services or PMS house. And I began by asking him how he was seeing the shift in flows and how markets were looking in coming quarters, and also where he was looking for value and in what kinds of sectors.
The kind of impact that Indian markets have seen, at least from the selling perspective of FIIs, it has been very sharp. It has been more than $10-12 billion in just about few months. So this kind of selling actually also led to a lot of money moving towards United States. As you rightly said, that with the fall in US, we may see some of these outflows actually receding. In fact, this is not the only factor. We really believe that the outflows actually has been driven not only by global vagaries, but with also from the perspective that Indian earnings have not been great. We are at a stage where for few quarters now, our earnings growth has been single digit. With all the steps that have been taken in many of the areas, there is high chance that next year we should be mid-teens in terms of earnings growth. So multiple factors actually now can contribute to how FI flows can actually play out. Global stuff which actually can alter the course, and also some semblance of earnings growth in the country. So which is why we believe it's only a matter of time that we start to see FI flows actually, outflows receding from the country.
Right. So if I were to take a step back, if you were to look at the way the Indian markets have been behaving in the last, let's say, 6 months to a year, they appear to be tracking Wall Street. They, of course, decoupled in some ways from China, other emerging markets. Are you getting a sense on how things could move in coming months? I mean, sort of India move differently from others. Could it track something else?
In the short term, when foreign flows are concentrated in a significant manner, and when these foreign flows are globally linked, those can have impact on our markets. It's not that India is completely decoupled. When you think about India from the perspective of merchandise trade or services, these two contribute between 20 and 25% of our GDP, right? They can get impacted by global vagaries. However, with all the changes that are happening in global supply chains, we believe we should be net beneficiary of the uncertainties that world is presenting. But there are a lot of or many parts of the country which are really domestic linked and which are relatively more insulated with how things are happening globally. Those would mean businesses in rural economy, even domestic consumption to a great extent, certain manufacturing related businesses. We really believe this is a phase where we should start to see gradual improvement in many of these areas.
You touched upon earnings outlook, and you said that one reason why there has been outflows, of course, the perception and fact of weak earnings, which you're saying now could recover. How's your sense? I mean, we are now in March, heading to the end of the quarter and year, financial year. How are things looking?
In the short term, possibly earnings may remain subdued, but we are already seeing steps that have been taken up by the government. In many areas, we are seeing project execution, seeing acceleration. Even the impact of tax cuts that have been announced in the latest budgets, and also quite a few of the incentives that are being given by state government, should mean that we should start to see earnings acceleration over period. Is it going to happen pretty sharply in the short period of time? Probably not. But clearly, we would see improvement possibly in quarter or 2 quarters. Really difficult to say whether it's necessarily going to be this quarter or next. But next year seems relatively better than what it is looking like versus FY25. So we think that possibly mid-teens kind of earnings growth is something India Incorporate should kind of deliver.
And when you say project execution, you mean public spending and government spending?
Yes. So government's focus this time is to make sure that the budgets that are there, which have not been met, at least if you think about FY25 capex number as well, which was announced in the budget last year, will not be met. So to that extent, this would be low. So the focus is how can we meet the revised numbers that have been announced.
What are the themes, and I know you're following a few that are standing out for you at this point of time in the context of all of this? Muted earnings, valuations under question, flows steady, at least overseas. Domestic, of course, flows seem still strong. So what are the sectors that are looking good to you and why?
Before sectors, I would first like to talk about what would work in markets at the current point. Last 3-4 years, markets have behaved in a particular manner. We believe we are back to 101 of investing. Focus actually has to be really high on what is the quality of business that you're buying? What is the quality of management that you're buying? What is the execution prowess that those managements deliver? This execution prowess actually has to show up in a superior profit growth. And this profit growth in isolation is not enough. This profit growth actually has to be backed by superior capital efficiency. Since we are in an era where uncertainties are increasing, we believe that markets will start to value those businesses that have ability to deliver a superior compounding over a long period of time. So those businesses possibly should start to see valuation polarization. Having said that, we believe there are a couple of opportunities in multiple areas, be it discretionary consumption or even the entire healthcare ecosystem, businesses in manufacturing, businesses like energy transition, circular economy, logistics. Many of these areas, we believe, offer very interesting opportunity from secular perspective in the country.
When you talk about superior compounding over a period of time, now, isn't that what has already driven valuations to this level, or you still feel there is opportunity before I come to the sectors?
See, last few years were an era where earnings growth for India Incorporated itself was 20% plus. Now we are into an era where earnings growth possibly from FY26 onwards should be in mid-teens. That would mean not all businesses would be delivering profit growth at that breakneck speed. So markets actually will now start to segregate those businesses which are delivering versus those which actually got lifted when tide was going up. So to that extent, execution will start to make a big difference.
So you talked about consumer discretionary, and that was seen to be getting a lift because of tax relief to middle class India. Has that played out in the way people were expecting it would, or is it looking like it's going to play out like that?
It has played out partly, but I think there is more to come there. So few businesses in tourism, few businesses in jewelry, I mean, those premium discretionary consumption actually did well. With tax cuts that have come by, which will start to show up from next year onwards, there would be relatively higher money in the pockets of the population, right? That coupled with relatively lower impact because of inflation, we really believe those small ticket consumption should actually start to see improvement. Even rural economy, which has already started to show some improvement as, I mean, post up this quarterly result season, many of the managements have been talking about improvement there. That should kind of continue.
And you talked about healthcare and its many constituents which are looking good to you. So can you walk us through that?
Entire healthcare ecosystem actually have many subcomponents, and every component is different. So when we look at healthcare ecosystem, we really believe domestic branded formulation businesses offers huge stable growth over next many years. Similarly, CDMO, while current uncertainty may have some impact sentimentally, but India has logical reasons to be significantly bigger in that space. Similarly, US pharma generic space, we believe that the rate of decline is kind of slowing down. And even if you think about drug shortages there, they are kind of increasing. So that is one area. Similarly, on the infrastructure side, with respect to pharmaceutical, the entire space of hospitals, diagnostics, medical consumables, those also offers very interesting opportunity at the current point in time.
And you feel if I were to stick to healthcare, many of these areas, valuations are still attractive?
See, what we are looking for in this area is what kind of growth can these businesses deliver over next many years. And we would start to see these businesses getting a lot more organized. Think about medical consumables. This is a significantly large industry. A lot of it is imported. There are huge smaller guys there. As we start to see consolidation in this space, we would see significantly decent growth for many years into future. So when growth runway is significantly longer, at that point, looking at short-term overvaluation, it can't be significantly overvalued, but slight overvaluation, I think market would be ready to live with that.
Right. And that's an interesting example. And Sumit, thank you so much for joining me.
Thank you, Govind. Thanks for having me here. It was great talking to you.
Oil prices are steady. Oil prices rose very slightly, about 1% on Tuesday, thanks to a weakness in the US dollar. Concerns of a US slowdown, our growing impact of trade tariffs are obviously continuing to weigh. Brent futures were up and oil stood at about $70 a barrel on Tuesday. Interestingly, switching away from oil but staying within energy, solar energy accounted for 84% of new electricity generation capacity added to the US power grid last year, though of course the new US administration's energy policies may change that, according to a report published on Tuesday quoted by Reuters. America installed about 50 gigawatts of new solar capacity in 2024, the Solar Energy Industries Association and Wood Mackenzie Group said in the report, adding that 2024 was the largest single year of growth by any energy technology in over 2 decades. Cotton imports to rise. India's cotton imports in 24-25 are likely to double from a year ago as production is set to fall below consumption thanks to a decline in acreage planted and adverse weather. Reuters quoted the Cotton Association of India saying, production is likely to fall about 10% from a year ago to about 29.5 million bales, even as demand is expected to rise to about 31.5 million bales. India is the world's second largest producer of cotton, and these imports could help support global prices, which have fallen to their lowest in more than 4 years, particularly after China levied duties on imports from the United States. The Cotton Association of India said India could import about 3 million bales of cotton, and the overall demand for cotton and potentially higher clothing and apparel production in India was something that was pointed out to us by members of the apparel industry just 2 weeks ago from Coimbatore. Tesla sales fall. Tesla's shares plunged to their worst day in more than 4 years, extending that 2025 slide. And the fall of the shares is actually to do with the fall in sales of cars. The stock fell 15% on Monday after UBS Group AG's Joseph SPAC cut delivery projections both for the first quarter and the full year. Other analysts lowered their estimates too for Tesla deliveries on March 6th, according to Bloomberg. SPAC sees Tesla handling about 367,000 vehicles this quarter, which is a 16% reduction from his prior estimate. And he's no longer expecting the company to sell more vehicles in 2025 than last year, projecting a roughly 5% annual drop. Analysts surveyed by Bloomberg, however, feel there could be a roughly 10% increase for the year and the company could return to growth in 2025. That's according to the company itself. Now, electric cars are facing headwinds in many parts of the world, except maybe in China, where Chinese brands are in any case dominating the field, having everyone's lunch and extending their chops to the rest of the world, including in India, albeit more slowly. More on Musk and an India angle coming up. Why is Reliance Retail downsizing? Last week, Bloomberg reported that the Ambanis are overhauling their retail business in an attempt to assuage investors who are looking for an exit option in the form of a public listing. Slowing sales is a concern for the company after brokers pegged its valuation as low as $50 billion. That's about half the amount at which it last raised funds about 2 years ago. Now, this was apparently acknowledged to investors in recent discussions. It was also acknowledged that the company had grown too big too quickly as a result of expanding across formats and geographies, according to people who spoke to Bloomberg. Reliance Retail operates through a structure of about 60 units that include mass market and luxury superstores, beauty and clothes, apps, and quick grocery delivery platform JioMart. The current focus, according to Bloomberg, which is also actually quite visible now, is to limit physical store expansion, cut back on marketing budgets, and merge Reliance brands with the umbrella retail entity and review some global brand partnerships. Hiring has also slowed down. Funds like Qatar Investment Authority and General Atlantic had invested about 8.2 billion between 2020 and 23 for a roughly 12% stake in the firm, according to an analysis by Stanford C. Bernstein, quoted by Bloomberg. Reliance Retail did about 273,000 crores of revenue and about 11,000 crores in profits for the year ended March 24. It had about 340 million customers at that time, around 19,000 stores and 4 apps. I reached out to consumer and retail analyst Karan Taurani and senior vice president at Elara Securities, and I began by asking him what the slowdown or the pullback by Reliance Retail actually reflected.
The situation is quite mixed right now. Two things are happening. One is, in terms of the consumption and the spending, it's a mixed bag as far as urban market is concerned. Whatever expansion we have seen beyond the urban markets, things haven't picked up as compared to what one would have estimated. That's the first thing. Second is that the competitive intensity is growing in itself in every category, every segment. And the third thing is the disruption from online, right? So the online business is kind of doing very well. Quick commerce is catering into multiple categories, including FMCG, grocery, even, some bit of apparel to a smaller extent, and other categories like wellness and, beauty, personal care put together. So there are concerns as far as retail business is concerned, and Reliance, as we all know, they're a large player with more than 19,000 stores which are present. And, in these kind of times where things are uncertain, they will have to kind of curtail their investments. Also, one interesting point, if you look at, is that Reliance is not able to scale up on their online business. So their online revenue contribution remains to be in the range of 17 to 18%. And that's been constant since the last, 8 to 10 quarters. Obviously, it's a very large scale in terms of the way they operate, and the revenue size is very large. But they haven't been able to scale up on their online revenue contribution as well.
I have a couple of questions. So let me start with the online part. Now, this is a 300,000 crore plus company with over 10,000 crores of profits. So if they wanted to, they could discount their way through all the quick commerce players in the market, couldn't they?
See, quick commerce is not a game of discounting, firstly. So, there could be many players who could come into the quick commerce market and just, give discounts and try and make business sense out of it. But that's not the case. I think quick commerce is a game of technology. It's a game of assortment. It's a game of convenience. It's a game of user experience in terms of knowing your customer, knowing your, local markets put together. That is why I think, e-commerce also, as of now, we feel that has a low likelihood of getting success into quick commerce, because quick commerce does a very deep dive in terms of every market, and that's not possible for every company to do it. So just capital, just pure discounting is not something which will give a moat to a quick commerce company. So I think Reliance obviously has tried digital businesses. They've tried JioMart within 30 minutes delivery, all those kind of new things, but none of them have been able to, match up with the quick commerce experience.
Got it. So let me come back to the large stores, and they have obviously thousands of stores. And what's your sense on what is worked for them versus what is not at this point?
So I think what works for them is the scale, the size that they operate, the kind of wide variety of categories that they have. They have got a very large presence in terms of the online fashion market. Ajio is kind of a market leader as far as online fashion is concerned. So these are certain things, which have probably worked in their favor. I think what's not worked is the offline business, I would say, on both on the grocery side, even on the apparel side. So I think these are some problems which Reliance faces. Offline businesses are not able to grow beyond a certain point. They made entry into multiple segments, the white goods segment, the jewelry segment, but the competitive intensity is very high in all these segments. Right? Despite whatever efforts that they've been doing in terms of store expansion, they're not able to kind of do well ahead of peers.
But is the market somewhere capped, and are people maybe not accepting it? So at 19,000 stores, is there really potential at this point of time in this country to grow for a retail brand?
So there is potential, no doubt about it. But right now, as I said, the market is quite competitive. You are seeing online brands, or rather online first brands, becoming offline, becoming omnichannel, right? Second, you are seeing a very big threat in terms of online adoption, be it via quick commerce, be it via e-commerce. So these are two things, which are kind of hampering the growth rate as far as offline retail is concerned in the near term. And I think that is why the expansion will be a bit slow.
So if you were to aggregate all the quick commerce companies in these categories, let's say consumer goods, daily consumer goods and so on, which is where they operate more in, and compare them to the large retailers, what would the split be? Wouldn't it be in the 10% or so, or even less?
So quick commerce is very small. If you look at the quick commerce market, it is not even 5% of India's e-commerce market. And in terms of overall retail as a category, it will be, less than 1%. Like FMCG, take for example, which is the largest category on quick commerce. Less than 1% of sales on overall basis comes from quick commerce. But the point I'm trying to make is that it's not only about quick commerce, it's also about e-commerce, because e-commerce is reasonably penetrated. White goods as a category is seeing very strong offtake as far as e-commerce is concerned. And that is where I think, Reliance needs to scale up. Okay. And there are many other categories like apparel, could be beauty, personal care, when they launched Elara, but they were not able to scale up beyond the point. So multiple category, multiple formats, they need to really do well, execute well. Only then you can see results.
So they are present in brand partnerships, and a lot of global brands, like they've brought to India. Now, they could be Japanese brands, they could be British brands. Now, what's your sense? I mean, where is the real value then between, let's say, the high-end partnerships, their own store brands, and at least if you go to look at how things have been in the last few years?
See, I think the luxury market is obviously growing very well. We have seen adoption of luxury goods because of increased number of customers, moving up the grade in terms of income levels, wanting to spend on high and wanting to spend on luxury. But as I said, the growth rates probably is growing at 25-30%. Luxury market is doing very well, but that's a fraction of the overall, retail pie. So one can't really piggyback on luxury as a segment and, kind of make sure that the Reliance Retail company grows at, 10-15% kind of growth rates. So I think luxury will continue to do well for Reliance because they have a wide variety of partnerships, as you said, in terms of global brands. But, one can't piggyback on that as a big growth lever for the overall business.
So if you were to look ahead now, and to the extent that Reliance is also, its numbers represent the state of the economy, at least as far as consumer demand goes, how are you seeing things?
So I think in terms of consumer demand, as I said, I think we'll have to wait till the festive season because I think this Q4 is not going to be anything great. If you look at Q1 as well, things are going to be quite mixed across various categories. I think we need to wait in terms of what is the future of the digital channels. Where does the quick commerce category go? Whether they can scale up beyond the metro markets, whether they can move from other categories except from FMCG. What about e-commerce? Are they reasonably penetrated? Can they deep dive further in terms of newer markets? Can they grow at a faster pace? What kind of share they can have? So I think for the next 6 to 9 months, there are two concerns. As I said, one is the digital businesses doing phenomenally well because of increased adoption. And second is the offline channel also struggling. And I think this is going to be a near-term risk for all the retail companies.
So in that sense, you're saying that the retail sector is not really looking as exciting as it maybe perhaps did in the 2021-22 phase or period.
Yes, absolutely. Because I think when 2021-22, we saw a revenge consumption situation wherein consumers actually came offline in large numbers. Footfalls had seen strong growth, which led to store expansion as well. We had seen the biggest highest amount of store additions in that period. And a lot of the landlords were also considering a lot of discounts that time around. People moved to rev share as well in some of the deals. But I don't see those things sustaining now. We don't see, revenge consumption in terms of footfalls. We don't see, discounts, coming from the landlord side as well. Economics of stores are being tested right now. Some stores are being shut down because of losses. So a lot of things to monitor in the near term.
Karan, thank you so much for joining me.
Thank you, Govind, as always.
And usually when markets are down, it's a time for deals, as one has seen in several occasions in the past. So lots of them announced yesterday, including listed companies. So let me take you through a few because they're quite diverse and interesting. Govindraj Ethiraj said it would buy a remaining 48% stake in Hyderabad-based Streamline Dairy Products for about 930 crores, which would obviously strengthen Govindraj Ethiraj's presence in the dairy sector. CDPL or Creamline Dairy operates the Govindraj Jersey brand and is a large private dairy player in southern India and has a turnover of about 15,400 crores for the last year. In healthcare, Zydus Life Sciences on Tuesday said it has entered into exclusive negotiations to acquire a majority stake in French company Amplitude Surgical for almost $280 million. The company makes high-quality lower limb orthopedic technologies. And finally, Bharti Airtel has signed an agreement with SpaceX to bring Starlink's satellite internet services to India. It said in a regulatory filing on Tuesday. The deal, of course, is subject to regulatory approvals for SpaceX to sell those services, that's direct internet access, in the country, and others are also waiting in the wings, including Reliance and Jio. Now, this is, of course, interesting because it shows that SpaceX seems to understand one part of doing business in India challenge, which is to go via a domestic partner, which is obviously helpful and could smoothen the road somewhat. The question now could be, will Elon Musk do the same with Tesla, where it clearly has been on a most restrained and test the temperature approach so far? Let's see. The official release says Airtel may offer Starlink equipment in retail stores and provide high-speed internet to businesses and bring it to rural schools, healthcare centers, and remote communities and thus bridge the digital divide. Airtel already partners with Eutelsat OneWeb for satellite broadband, and Starlink will obviously be part of that portfolio. And before we go, in this world of digital connectivity, the high value cyber fraud jumping to nearly 4 times in 2023-24, that's causing losses of about 177 crores, which obviously highlights the increasing risks of high velocity digital financial transaction and, of course, smart scamsters. This obviously is not the whole amount because not everyone reports what they lose. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.